Hello, this is Dr. Russ Wallers, your Marketing 300 online professor in Ball State University's Miller College of Business. We're broadcasting this week live and in color from the third floor of the Wallers Sailing Institute and Marketing Command Center located in beautiful Muncie, Indiana. In this video overview, we'll be looking at some selected specific pricing applications associated with your reading assignment. I'll be addressing some cost-oriented price-setting methods, some selected demand-oriented price-setting approaches, and a few other pricing issues of practical interest. One word of caution regarding this material is that some of the following content here and in your reading assignment is rather technical. This is an important area within our course, and I would strongly suggest that you study this material thoroughly and thoughtfully work through the problems found in your reading and the ones we'll discuss in this video overview. In tuning up your thought processes required to master this material, you might want to think about some of the concepts that you've already discussed in your prerequisite economics coursework, specifically concepts regarding market structures, price elasticity of demand, marginal analysis, and even cross-price elasticity of substitutes and complementary products. So, let's get started. Let's start our discussion of different pricing approaches by drawing a distinction between manufacturing firms and intermediaries, which would include retailers and wholesalers. In general, whereas most firms will tend to use both cost and demand factors in pricing, manufacturing firms as a group often tend to use an approach for setting their prices that we generically call cost-plus pricing. In this approach, this starts with estimating fixed cost per unit, and to do this the marketing manager basically takes an estimate of operating volume in units and divides that into the firm's total fixed cost. That arrives at fixed cost per unit. The next step is to add variable cost per unit. This amount would include such factors as material, direct labor, etc. Then an amount reflecting a fair profit is added to this amount. The result is a selling price. This is easily justified to consumers because it's a build-up approach, very easy to explain, fairly easy to do if the firm has a limited number of products. One problem with this approach, however, is that it does ignore the demand function, and we'll talk about that in a few seconds. In contrast to manufacturing firms, most intermediaries, retailers and wholesalers, tend to use a markup approach to pricing. The reason for this is fairly simple. Firms like Macy's or Kroger, Marsh, various retailers are often handling tens of thousands of products, and it becomes very impractical for them to allocate fixed cost to each of the individual items that they carry in their operation. So rather than attempt to do that, they simply add a markup amount to the landed cost of each of their products. And this markup amount added to the landed cost equals the selling price. This assumes that the price minus their cost equals an amount reflecting not only the item's contribution to fixed cost, but also a fair profit. So that's the markup approach. Regarding markup pricing, this is very important. When retailers and wholesalers talk about markup, the convention by default is that markup, unless otherwise specified, is markup on selling price. Sometimes we refer to this as the margin. Here's an example. Let's assume that a retailer's cost of an item is $200. To that landed cost of the item, let's further assume that the retailer adds $100 as a markup amount, resulting in a $300 selling price. The markup can be calculated by taking the amount of the markup divided by the retail selling price, and in this case that amounts to 33 1/3%. This is often referred to the margin or markup. The markup on cost, however, would be calculated by taking the dollar amount of the markup, which in this case is $100, divided by the cost, which is $200, so that equals 50%. So in this example, a markup on cost of 50% yields a margin, or a markup on selling price, of 33 1/3%. Here are two useful formulas that you might want to memorize. You can calculate the markup on selling price if the markup on cost is known, and likewise you can calculate the markup on cost if the target markup on selling price is specified. So to calculate markup on selling price, all we need to do is take the percentage markup on cost divided by 1 plus the percentage markup on cost. Likewise, the percentage markup on cost, assuming we have a selling price percentage specified, the percentage markup on cost would be equivalent to the percentage markup on selling price, with a margin, divided by 1 plus that margin. Here's an example in the form of a question. Let's assume a retailer sets the selling price for an item costing $125 so as to yield a target markup or margin of 30%. What is the item's selling price? The calculations are shown on this graphic. Again, we're just using the formula at the top of this screen. The percentage markup on cost would be found by taking the target margin of 30% divided by 1 minus that margin, and in this case the result would be 42.9%. That's the markup on cost. So if we go back to the landed cost of the good, which is $125, if we multiply that by 142.9%, that yields a retail selling price of $178.63. And as you can see, the actual markup in dollars in this example would be $53.63. Here's another retailing term that relates to pricing. Many retailers refer to a pricing approach called keystone pricing. Keystone pricing involves simply doubling the item's landed cost to arrive at a selling price. Thus, the keystone price involves a 100% markup on cost. The resulting markup on selling price, or margin, is calculated using our formula: markup on cost divided by 1 plus markup on cost. In this case, it's 50%. So this is a useful term to remember, and a useful relationship between markup on cost and margin. If a firm uses keystone pricing, they're basically doubling the cost of the item, which is a markup on cost of 100%, and the resulting margin is 50%. Very commonly used retail technique in pricing. Here's another example to check your knowledge. Let's assume a clothing retailer charges $300 for a men's suit after getting it from the wholesaler for $150. The retailer's markup percentage is A, 33%, B, 100%, C, 133%, or D, 50%, or E, cannot be determined from the information provided. If you want to stop the video and work this out, that would be a good time to do that. We'll take a look at the answer. Here's the solution. We see that the selling price of the item as specified was $300. Subtracting the retailer's cost of securing the item, we see that the markup amount is $150. Therefore, the retailer's margin, or markup, is 150 divided by 300, or 50%. Again, note the markup on cost is 100%. This is another example of keystone pricing. Here's a graphic that shows the relationship between cost and markups as a product goes from producer to wholesaler to retailer. it might be useful to think that through in light of our earlier examples and see if this makes sense. The horizontal line at the bottom of this graphic shows the relationship between the different participants in the marketing channel and the amount of markup that they extract from the product in marketing this product as it moves through the distribution channel. Here's another example that's very important to understand. Average cost pricing is commonly used by many manufacturers, and this can be dangerous. This actually relates to the first example that we talked about. Let's assume that we have a manufacturing example, and the marketing manager has an estimate of the fixed overhead expenses for the firm, in this case shown at $30,000. Labor and material at 80 cents a unit is calculated at $32,000. Now this is based on a sales forecast or an initial estimate of volume of 40,000 items. It's very important to understand this is based on an assumed quantity level. So the labor and materials is estimated based on that 40,000 unit estimate. So the total costs shown are $62,000. Let's assume a planned profit amount of $18,000 is added, so the total cost and planned profit amount is $80,000. At the bottom of this column we can see that if the firm does in fact sell 40,000 items, the profit result is $18,000. One of the problems, however, is that demand has not been directly calculated into this example. We're making an assumption that the firm can in fact sell 40,000 items. Now on the right, here are some calculations of actual profit in the case that only 20,000 units would be sold. Again, the fixed overhead expenses for either volume would be the same, $30,000. But if the figures are budgeted on a sales base of 20,000 units, labor and materials recovered only amount to $16,000, obviously half. So the costs are not recovered at as fast a rate. So if you look at the bottom of the page, bottom of the column on the right side, we can see that the calculation of actual profits, if only 20,000 items are sold, amounts to a loss of $6,000. So the lesson here is that if cost plus pricing is used based on average cost of an assumed quantity level, the resulting price is subject to the demand curve. So we have to be very careful in making these estimates that the amount of the budget can be expected given the price that we end up calculating. In this case, the selling price that we calculated was $2 each. So the issue is how many units can we expect to sell at a price of $2? Maybe only 10,000 units. We don't know from this example. That information isn't given. But the point is, when you use average cost pricing, you have to be very careful regarding the assumption of how much volume you'll generate at a given price when you're making estimates of profit. Marketing managers must consider a wide range of different types of cost. This topic is very well developed in the text, and I would recommend very strongly that you review this very carefully. Total fixed costs are self-explanatory. Average costs are basically the average cost of a product based on an assumed volume level. Average variable costs include direct material cost, labor cost, and so forth. So when you read through the book, make sure that you cover thoroughly these various terms. Here's an example that shows cost relationships at different quantity levels. This ties in with the example that we just talked about. Again, in the second column, you'll see the total fixed cost budgeted at $30,000. The average fixed cost will obviously change based upon different assumptions regarding quantity. And you can see in the rightmost column, if you go to the rightmost column and look at how the average cost changes based on different assumptions on quantity, there's a wide range of prices. If we assume that 100,000 units is realistic, our average cost is $1.10. On the other hand, if only 10,000 units can be expected, the average cost jumps up to $3.80. That's a huge difference. So we have to be very careful when we use average cost pricing to make sure that we consider that the price that these quantity levels are based on are achievable. That topic is very well developed in the text. Here's an example of break-even analysis. This is a technique that's often used to evaluate alternative prices. In this graph, the horizontal axis shows units of production, and the vertical axis shows dollars of revenue and cost. And you can see that we have basically two linear functions. We have a total revenue curve, which is simply price times quantity. And then we also have a total cost curve. The point where total revenue and total cost intersect is our break-even point. And if we drop that vertical directly downward from that break-even point, the intersection of total revenue and total cost, on the quantity axis, that tells us how many units we will be required to produce in order to break even. Notice the area in red is a loss area. That's the area where the total cost is higher than the total revenue. That would be within a production level less than the break-even point. Anything to the right of the break-even point, in this case 75, we'll see above that the total revenue curve exceeds the total cost curve, so the area shown in light blue would be the profit area. That's a very simple example of break-even analysis. Here's an example of a break-even problem that you might want to work out. A company has total fixed cost of $500,000. Its per unit variable cost is $5, and its price per unit is $10. What is the break-even point in sales dollars? And we have four choices. Choice E is cannot be determined from the information provided. So if you want to stop the video and work this out, that would be fine. Probably a great idea. The solution is shown here. BEP sub Q is the break-even point in units. The formula for determining that is to take the total fixed cost and divide that by price minus unit variable cost. In this case, that would be $500,000 divided by the price minus the variable cost per unit, and that's equivalent to 100,000 units at the break-even point. To compute sales revenue, we would take that 100,000 units and multiply that by the assumed selling price of $10. So the sales revenue resulting from this would be $1 million, which is choice C above. Very simple to calculate that. One caution, however, is we have to ask the question, can the firm in fact sell 100,000 units at $10? We don't know what the market price is because we have not considered demand. What if the demand market structure is such that the average selling price in this competitive market is $5? The question is, can the firm sell 100,000 units? So all this break-even analysis is telling us is what profit would be obtained if we assume we can sell a certain number of units in order to break even at a assumed price level. So again, we have to be very careful to understand that we have not considered demand. A lot of this is up to the marketing manager's judgment to make the assessment of whether that $10 is in the competitive price range within the market within which the firm's dealing with. Marginal analysis focuses on the changes in total revenue and cost from selling one more unit. Marginal analysis helps find the right price that maximizes profit. This is especially important when the demand curves slope downward, which is usually the case. Demand estimates involve if-then thinking. Managers must estimate the quantity that will be sold at several different prices. The demand curve is the graph of all the price-quantity combinations. The price multiplied by the quantity sold is the total revenue generated at each price-quantity combination, as shown in the first three columns from the left in this exhibit. Profit is the difference between the total revenue and total cost. Marginal revenue is the change in total revenue that results from the sale of one more unit of a product. At some point, selling more units no longer contributes the same profit to the firm. The marginal revenue can be, in fact, negative. Marginal cost is the change in total cost that results from producing one additional unit, and this can be especially important. The rule for maximizing profit is that the highest profit is earned at the price where marginal cost is just less than or equal to the marginal revenue. At this point, the marginal profit, the extra profit on the last unit, is near zero. Here are the total revenue, total cost, and profit curves from the previous slide. A profit range is reassuring because it means that the demand estimates of price and quantity don't have to be exact for the firm to make money. In this case, it appears to break even at 2 units and is profitable at sales between 3 and 9 units. Marginal analysis applies in oligopoly situations as well. In oligopolies, marketers often set prices that match competition. Marketers do this because marginal revenue drops sharply if the price drops below the market, making the market price, in effect, the profit maximization price. A price leader usually sets the price in an oligopoly, and this leader is usually the firm with lowest costs. If a price leader tries to lower the price, price wars often result. But these price wars tend to be short-lived because they are so unprofitable for the industry. Marginal analysis forces the marketer to consider both costs and demand in setting price. In practice, the profit maximizing price tends to be a range of profitable prices. Thus, a rough demand estimate is much better than none. There are other demand-oriented approaches for determining prices. Psychological pricing attempts to discover the price range a customer prefers for a given product. Price cuts within the range don't affect demand that much. Odd-even pricing sets prices to end in certain odd numbers. For example, $49 instead of $50, $24.95 instead of $25, $99 instead of $100, and so forth. Research on the benefit of this method are somewhat mixed, but it tends to be effective. Price lining sets a few price levels for a product line and then marks all items at these prices, so a few prices cover the field. For example, groups of neckties may sell at $10, $15, or $20 each. This technique is frequently used in fashion merchandising. Demand backward pricing involves setting an acceptable final consumer price and then working backward to what a producer can charge. The keys to successful pricing are an accurate estimate of what constitutes an acceptable price and making sure that the firm can still cover its cost. Prestige pricing sets a rather high price to imply high quality or high status. Prestige pricing is commonly used for luxury goods such as furs, jewelry, and cosmetics. Because most marketing managers are responsible for more than one product, it is important to understand how a full line of products is priced as part of the firm's overall competitive strategy. Full line pricing is setting prices for a whole line of products. It may be market or firm oriented. In market-oriented pricing, the firm makes a line of products that are all aimed at the same general target market. The difference in price should reasonably reflect the differences in the features for each version of the product. In firm-oriented pricing, the firm makes a line of products where each product serves an entirely different target market, so there doesn't have to be any relationship between the various prices. Costs are complicated in full-line pricing. The marketing manager must try to recover all costs on the whole line. However, estimating costs for each product is a challenge because there is no single right way to assign the company's fixed costs to each product in the line. Managers must also consider the demand for each product in the line. Complementary product pricing means setting prices on several products as a group to increase sales for the group as a whole. One product may be priced very low so that profits from another product will increase. An example of this happened several years ago where Gillette sent free samples of its Excel razor to millions of men, but included only one blade. The idea there was that the free razor would stimulate the sale of the complementary goods that go along with it. We see this done quite a bit in other areas involving other products. Bid pricing means offering a specific new price for every job rather than setting a price for all customers. This can be as simple as setting the lowest acceptable selling price, as is the case in reverse auctions online. Or it may be much more complicated, as when a contractor bids on many different projects. Cost estimation is the biggest challenge in bid pricing. In spite of this challenge, sellers must be equipped to respond quickly to invitations to bid. Usually these bids are based on the buyer's specifications for the product or the service. There are ethical issues in cost-plus bid pricing, such as overinflation of cost figures by sellers. Given that there will likely be other competitors for any given bid, sellers need to give considerable thought to the overhead and profit figures they add to the costs of the product, because they may have a significant impact on how bids compare to each other. So demand must be considered as well as cost in submitting bids. Additionally, sometimes bids are negotiated. Sellers whose initial bids are attractive may move to additional rounds of negotiation to arrive at a final price. Other times, the lowest bid is simply accepted. The negotiated price is the price resulting from bargaining between the buyer and seller and focuses on what a specific customer will pay. All the marketing mix variables may be negotiated, not just the price. So that pretty much wraps up an overview of your reading assignment for this week. I hope you've enjoyed this discussion and have developed both an appreciation and working knowledge of some of the challenges faced by the marketing manager in setting prices based on both cost and demand issues. Be careful out there, and I hope to see you online again soon. Thank you.